Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Hey, welcome back for part 2 with Joe Downs. Let's get started. So I do want to go back, though. I want to ask, because one of the things that was interesting to me, partly because I've got some background on that as well, but so you owned a bar and restaurant.
You're not going to let me skip that part.
Yes, I'm not. So give our audience, kind of just a brief synopsis of that, right?
You're a private investigator?
But so not just like, hey, here's the name of our restaurant and here's where, but briefly, what got you in it? But more importantly, what did you learn out of that?
Yeah. So, I did. Every young male's, I think it's in our DNA, that if the opportunity to own a bar is in front of you, it's like you can't say no. It's like the hottest woman in the world asking you to dance, right? Like you're gonna say yes. So I had to take that opportunity. Now, it wasn't out of the blue. I bartended at the bar that I ended up owning for 9 years. So remember, I said I always had 2 jobs. So even while I was a financial advisor, I was bartending Thursdays and Saturdays.
Okay.
And which was great for any number of reasons, but it was actually a Villanova college bar, and it got shut down because the owners were morons. But that's besides the point. And so they wanted to reopen it. And here was my exit from the financial advising world into, I'm going to be a business owner, and it's going to be a bar and restaurant, because that's the path I should have always been on, because according to my mom, some distant cousin in Ireland owned a bar too. So it must be in my blood. So I knew the front of the house, the bar itself, because this was such a college bar that, I was like one of the head bartenders. So the only thing I didn't do was order the alcohol every day. Like that part was easy. So, but the restaurant part I didn't know. We had to shut it down, redo it, kind of turn it into more of a pub than just a bar. And it was great. It opened up. We were gangbusters. This was the first not the first mistake, but the first big mistake I can think of that I've made in my life in the business world. And this is what I tell people all the time is my analogy that I use based on this experience is you have to keep your head in the kitchen. You got to know what's going on in the kitchen. And for me, that was literally the kitchen. And I trusted the chef, and I allowed him to do the ordering. And not only was food walking out the door with some of the cooks that we ended up catching because we saw cameras and stuff, but the chef was just ordering whatever he wanted. And, it was a chef's dream because he got to be creative every week, which I thought was great, not realizing, hey, he's being creative. He's not being judicious or and today we would say he's not value engineering anything, right? He's an architect, and it looks perfect that he's got an unlimited budget. And sure enough, the food was great and the specials were great, but they weren't. I was losing money, and unfortunately, couldn't sustain itself. So, ended up losing maybe $100,000 there, which was year and a half of college, the average college today. Except I learned a lot more, I think. And I had to it took a couple months off. Had to reinvent from there, and then my brother-in-law. I knew I needed to work, but I didn't know what the next move was. So I took a job in sales, radio sales, selling advertising on the radio for a conservative talk radio station. And that's actually how I got into real estate, which was where I wanted to be my whole life, but foolishly thought well, I will say two things. I foolishly thought I didn't know how to get into it. And two, and maybe more importantly, and I'm just recognizing this so a little self-reflecting in this intervention you have going on here, is I don't think I tried hard enough. If I really wanted it, then if I had someone encourage, if I was pushed, I probably could have broken in, but I don't know. I think I wanted it, but I didn't know how to try hard enough. I don't know. Maybe I just didn't know how to try hard enough then in life. Who knows? So I took a circuitous route to real estate, but I'm where I belong, and I'm where I love being. And how did I get there through radio, you ask? Since I know you're going to ask, you're not letting any silly little intrigue here.
I was going there next.
One of my clients that came along, and this was just serendipitous, was it's called Real Estate Riches, and they put on there were no podcasts back then, or if they were the first podcast. But we did everything by seminar, not webinar, but live seminar. So they advertised to our listening audience because we had the right demographics in terms of age and, who had money, discretionary income, et cetera. It was because it was conservative talk radio, and it was, AM radio. So that's who the audience was. And it was perfect audience for, if you're going to advertise on the radio, that was the audience. And we would put about 100 people a night, 2 nights in a row, once a month in a hotel for a seminar. And they would teach people how to buy, rehab, and either rent or flip single family homes, Real Estate Riches. And they were pretty successful. And I learned how to do that. I started doing it. I think I probably started wholesaling first because I was broke, coming from losing, everything I had.
Yep.
And actually owing money. So I was more than broke. I was broke and in debt. But I scrounged up $5,000 and paid. That's all it cost, by the way, $5,000, and paid for a mentorship. And I think I started wholesaling houses first, and then I got a partner because, again, it's money. And I think we rented a few, flipped a few, or we tried to rent them and flipped them. I don't remember. It's hazy. It's a long time ago, but with moderate success. But making money in real estate as my third job, because I was still bartending, because I still bartending at another bar, just because I was broke. That was a common theme at this point. And starting out in radio sales without a book of business. So, I had to draw, and then what I made bartending. And then on Saturday and Sunday mornings, I was out looking at property. So I had 3 jobs. And then another client was that came along. I actually sold them. The first one came out of nowhere, but I went and pitched them, was a developer. It was a developer I knew. And actually, the week of 9/11, one of my buddies and I there was nothing to do that week. The market was closed. So we both belonged to a golf club, because it was doing okay, but I was a single guy, right? So then it was not an expensive club, but we both belonged to a golf club. So we went there to play golf every day. There was nothing to do. And one day we were having a few drinks, sitting around saying to ourselves, like, and I knew I wanted to be done. That was the week I was like, all right, this is it for me. And I was like, what are you going to do? Like, how do I get into real estate? Or no, sorry. What we said was, we were just joking, like, who's the wealthiest guy you know? Let's do what he does, type of thing. And then it got serious, and I was like, hey, seriously, who do you actually, like, who's in your phone? If you called them right now, they'd say, hi, Jamie, or hi, Joe. And mine were both guys in real estate. And one was a developer and one a multifamily. And I was like, that's it. That's where I'm going. I'm going to find a way in. So selling radio was just a stepping stone. I did not know, and this is maybe part of the message is, you never know when one door closes, another one's going to open, and just take the next experience and be open to anything, because I didn't go into radio thinking this is my pathway into real estate, but it ended up being my pathway into real estate. Right. So anyway, this developer comes along, they want to sell these high-end condos, and their demo unit was across the street from our office. And so I ended up, I became friendly with the head sales guy who was the broker. And when I didn't feel like going out on the road and selling, I would just go over there and we would shoot the shit for a couple hours. Or he'd text me like, "What are you doing? This, it's a rainy day. No one's coming in." So I'd go over and hang out. And anyway, he had a friend who was looking for a sales guy, and he was in 1031. It was starting at 1031 exchange tenant in common company.
Yep.
And buying multifamily and office buildings, and needed a sales guy to raise the money. I interviewed with him, and I wasn't in commercial real estate. I was barely in real estate, dipping my toe in residential with some, flips and wholesales and stuff. So I had to learn commercial real estate, but he knew he could teach me that. He needed, what I brought to the table otherwise. And ended up in that business, and that was fantastic. And that's when I, we had a great ride, raised $93 million of 1031 exchange money in a couple of years, and then it all went poof, almost overnight. But the writing was on the wall for a couple months. We were the last loan Citigroup did in 2007, and we had to threaten to sue them to do it because we'd already gotten approval, and they didn't want to close. So we had the commitment, and they didn't want to close, and we just threatened to sue them. But the writing was on the wall because they didn't want to do that loan.
Yeah.
That was October of 07. November. Okay. And then 08 was not a fun year, and then I was out by the end of 08.
So what got you transferred then from traditional real estate into storage?
So my life has been a series of reinventions, and I in 2009 had to reinvent again because my industry, which was a $4 billion equity exchange industry, went down to $250 million in like 2 years or a year and a half or something. So the industry was kaput for a while, and so I had to reinvent. So I started doing. I got a mortgage. I got a mortgage license. I started originating residential mortgages, and that's when I met. I went to a tax lien seminar in Philadelphia because I was looking at anything in real estate, anything real estate related. I loved real estate. Didn't want to leave real estate, but it's not like real estate was in a good place then either, right? It was in a really bad spot actually.
Yep.
So it wasn't like people were hiring a guy like me. So I knew I was going to have to figure it out for a couple of years. Unfortunately, I'm married. My wife has a good job. So I meet this guy at this pyramid club. We had a mutual friend that invited us to this event. And it was a tax lien seminar, which was interesting. And he lived near me, and we agreed to start meeting up. He was in a different but similar situation. His wife had a job, and he was reinventing. I think it was coming out of he had just gotten hurt. He had what's the name of those franchises? The We Buy Ugly Houses franchises, whatever it's called. Home investors, right?
Yep.
Yeah, home investors. So he had just gotten hurt in that. And so we were both looking to reinvent. Ended up stumbling into distressed debt, went to a seminar. I'll never forget the first night of the seminar because I almost didn't go. In fact, when people ask me, is there a decision you made that changed your life? An important decision. And I said, yes. And I always talk about that night. I could look up the date. I don't remember, but I know what was significant about that night. I'm sure it was an October night because it was the game 1 of the World Series, Phillies, Yankees. Cliff Lee was on the mound. Phillies had just won 102 games or something like that. So they were the odds on favorite. And they did not win that World Series, by the way, but it was October-ish of 2009, whatever the night. I went to this seminar on distressed debt. It was just specifically reperforming residential second mortgages. Think about that. Residential second mortgages. Pretty esoteric.
Yep.
And I was the guy who was like, question. And it didn't hurt that I knew some of the guys putting on the event from just being in local real estate. And so I ended up buying one in my IRA and came back and told my then became my partner and still is my partner in debt, Tom Dunkel. I said, look, these guys are selling 25% yields to us as investors. What do you think their yield is? They're selling at 25. Theirs has to be 50 to 100, right? So I said, if there's that much margin in here, I just raised $93 million at 6.5% yield on average.
Yep.
So there's something to this. We got to figure this out. So we ended up learning the business and buying. We put our $11,000. We scraped together $5,500 each. Bought 6 non-performing mortgages from a company that was selling them. And with that, we got 35 stories we could tell, and experiences. And I think,
now these were firsts or seconds?
Second mortgages. People, when we first started to raise money for this, everybody told us we were nuts. People that should know better.
Yep.
And the more you tell me something like that, the more I'm like, well, why? What don't you know? Right. So I'm a be curious, not judgmental person. And, I'm not following sheep off of a cliff, but I will walk to the edge and see if it's a cliff or if it's a foot down and there's paradise on the other side. Right. So, I walked to the edge of the cliff and I said, wait, it's not bad at all here. In fact, if you maneuver down this way, it's paradise. So, it just took a little effort and understanding. And so we bought 6 notes and I think 3 or 4 of them ever amounted to anything. And that's actually pretty high percentage wise for, if you buy 10, we will sell people, but it was incredible in terms of, what we learned and what we were able to build on top of that. Our first, by the way, I'll never forget, probably still have a copy of it. Our first mortgage payment, because we want to get them reperforming, was from I won't say her full name out of respect, I guess. I don't know. Her first name was Dagmara, and it was a $50 check, $50 got it all started. Today we've been in business 15 years. We're probably the largest buyer of distressed second mortgages in the country from banks. If we're not we're one of them. But that's also is another way of saying we're a big fish in the world's smallest pond. As far as niches go, it's the nichiest of the niche. But it was an incredible hobby, and you're probably going to ask me then, well, how did you get into storage from that?
Yeah, that's what I'm anxious, because now, we've talked about you, and so I want to get our investors in, because like I say, the storage side of it is what I want people to start hearing some stuff about. I just, sure. Again, I know we've got a few that deal in storage and stuff like that, but I'm anxious for our audience to start hearing about this asset class. So cool. So what took you out of that, let's call it traditional world, even though second notes is kind of a different aspect of that. But here's the thing I want our audience to see. Even in that process, Joe, you were, whether it was by design or whether it was by force, you didn't lay down and take it. You figured, okay, I've got to pivot, and it may be because I have to eat this week, so I have to pivot. Right, but you figured a way out to pivot, to work through what the markets were throwing at you. And that's part of what that I'm taking as I'm listening to you tell your story. You're proving out what we teach day in and day out is if you go into deals and don't have ways to pivot built in, you're short-sighting yourself before you even start, right? So I love the fact that maybe you didn't have them built in and you had to learn like, hey, I've got to figure this out, but you pivoted. But yeah, let's show. All right. So how did you move from traditional, real estate into the sector and the section of storage?
Yeah. Real quick on what you said there. Cause I agree with what you said. We also look at, and this is what we always look at with notes, is there's always multiple outs. So to your point, when you're going to a real estate deal, what are your outs? What are your exits? We're always analyzing the exits, and there's only one. Better be pretty sure.
That's right.
They're always looking at multiple exits, and we got that actually from our notes world, because you can exit through the borrower, which is payments, or you can exit through the property. Yep. There's always 2 outs there. So when the CFPB was created, so now we're circa 2015, 16. because we had been running our business for a while. Things were going great. We were on the climb. We went from buying the notes from intermediaries to buying directly from banks. So we cut out the middleman. And things were on the up and up. Things were good until the CFPB was created, which the point was, well, I don't know what the point is. The point of it was, the effect of it was it put onerous regulations on the banks to the point where, in particular with their distressed debt sales, both first and seconds, to the point where they basically said, it's not worth it to sell these things to you guys. So we were looking at being out of business for a while. Now it wasn't forever. It was an indeterminate amount of time, but it started to feel like forever. So we had to reinvent again. So Tom actually started to go in the multifamily direction with with his family, with another friend. And I actually advised him that I didn't think that was a good idea based on my experience in it, but up to you. And I started to do hard money lending on my own. And started from scratch, and I built it up to in about a year, I built it up to making from 0 to 125 grand a year. I mean, wasn't nothing, but
yep.
And I was looking at, all right, is this going to be what I do now, or is this again just a measure to feel worthwhile and bring them some money and whatever. And that market, and it was growing. And then one day I got an email about self-storage from this guy, Scott Myers. And I don't know so this is probably 2016, let's just say, somewhere in 2016. I don't know the first thing about self-storage. In all the commercial real estate and all the alternative investment conferences I went to from 2004, call it, to 2014. So 10 years of conferences. I mean, I'm in Vegas 30 times. I never need to go back. I never once saw a self-storage operator. I didn't know the first thing about self-storage. I never rented a self-storage unit. If you had asked me what was self-storage back then, I probably would have said, I don't know, those buildings with the orange garage looking things. That would have been my answer. That's how much I knew about self-storage. This email comes in and it says real estate without toilets, tenants, and trash is the subject line. I'm like, what's this? Sounds like another BS thing. Open it up, and that wasn't what hooked me. It got me to open the email, but what hooked me was this stat, which is different today, and I'll update it for you. But in 2016, the stat was 80% of all self-storage facilities are owned by mom and pop owners. And I went, what? Because at this point, I've read, a little bit about self-storage once I got the email, and I started thinking about it, and I was like, wow, I would have thought it's more like 80% owned by Public and Extra Space and CubeSmart. And
yeah, institutional buyers, right?
Yeah, that just kind of rocked me. And the reason it rocked me was because of my experience in distressed debt. And in particular, my experience in second mortgages. Because second mortgages are so esoteric. Real quick window into that world, we buy from the bank in a large pool. Maybe, in fact, we just closed on one a couple months ago. We got 115 million of debt. That's 2,500 loans, call it. We buy what other smaller buyers can't buy. And then they'll buy from us. So there's a markup there, right? Yep. We'll try to work them out. We actually, our goal is to get them modified, but if we can't, or we can't get in touch, whatever, we'll sell them. So I know what that world's like because we created in a lot of ways the rules and for the downline. This is how the transactions happen, right? It's just, and what's something worth? Well, there's no Zillow for it. This loan is worth this. So to me, I didn't know anything about self-storage, but I just knew that 80% being owned by mom and pop means it's not an efficient market. there's inefficiencies out there somewhere. Have to be. This is what I want to investigate to see if it's worth it. So I bought the at-home course. I read the whole thing, the binder. It came with like the DVDs for your laptop, which my laptop didn't even have a DVD player anymore. It was, and I was like, all right, well, it's one of the, most of those education programs are a little older in terms of the form that they are delivered in. And so I wouldn't think too much about it. And then there was an offer to go to their academy and wherever it was in Indianapolis. And I politely declined because I was not broke, but I was back to being, not flush with cash in my, reinventing again. So I was like, I'm not traveling for this. It's interesting. I don't know how to make it work. We'll see. And then about a year goes by and I get a call from that company, the education company, Scott Meyer's Self-Storage Investing. It said, hey, we're going to be in Philadelphia for an academy, and you've already paid to be there as part of your at-home education course. So I said, well, all right, it's free. All I have to do is drive to downtown to the airport hotels for, a couple of days. I'll just do that. So I went to that academy, and that's where I learned about the business, and my suspicions that I had when I first got that email about it being very fragmented, dislocated market were I think pretty on point. Not so much today, but it's a tremendous amount of opportunity in self-storage because it's still so dominated by mom and pops. In fact, different sources say different numbers. Some say still 70%. I'd say it's safe to say still at least 65% of facilities are owned by mom and pops. And that number is not likely to drastically change because you could say, wow, it sure did in 6 or 7 years, but there's a size matters in self-storage. So there's a kind of a demarcation line as to where the big boys will go down to in terms of how many square feet the facility is. So most facilities most of the smaller facilities are the ones that are owned by the mom and pop as well. So we put the number at it comfortably. There's 20,000 self-storage facilities comfortably. There's probably 30, but at least 20 that will change hands in the next 10 years because they're all owned by mom and pops who are 65 plus.
Now, when you say small size, what's small size for you in storage?
I'll give you small size for a REIT. So for public, they don't, the REITs don't generally want to go below 50,000 square feet.
Okay.
That's on the small side for them. Will they, if it's a 40,000 square foot facility a mile away from one they already own and operate that's 100,000 or 75? Yeah, sure. So there's exceptions, but in general, they're not going below 50. So there's a subset of institutional buyers that sit below the REIT, and their bandwidth, everyone will always buy as big as possible as long as you're getting, the deal works that you've negotiated. But they'll go lower than the REITs. They'll go down to 30, but that 30's got to be, the they're really more of a 40 and up.
Sure.
Maybe 30 if it's an appendage if it's a hub and spoke scenario. So where do these 20,000 fall in size that I'm talking about? 30 and below.
Okay.
Down to 5,000.
So, for a lot of our investors, we got a lot of seasoned investors. I mean, some of these guys have thousands of doors that follow what we do. And we got a lot of new guys and ladies that are just coming into this industry. Right. So, obviously on a cash flow setting, because storage is not going to be that, hey, we're going to go in and paint this and now flip it tomorrow. I would imagine that's not a strong business model in storage. Whether you're buying an old and whether you're putting a new one in, things like that. So from a cash flow perspective, right, and a longevity of the hold on the asset, what do you see as the biggest way that you can explode value within storage units? Is it in operations or? Hey, surely I'm saying this tongue in cheek, but painting the eaves and painting the doors a brighter orange is not going to increase the volume or the value of that. So where do you guys get that in storage?
You nailed it. So for your listeners are mostly multifamily residential, right?
We got SFR, we got multifamily, fix and flip.
Residential,
Yeah.
right?
Yep.
So in residential, we all know there's nothing more clear than a before and after picture, right? So we know we can, whether it's a single family or a multifamily, we can go in and we can change out the countertops and make them granite or, whatever, carpet paint or not carpet paint, whatever. We know we can go in and make something stand out. And as long as the location is suitable enough, right, we can get more in rent for that location because of the physical improvements we made. Storage, do we make physical improvements? Sometimes. They're invisible, though. For the most part, they're invisible to you, the average storage. We'll call you the storage customer, right? They're just, to me, I know what they are. They're putting bollards on corners. They're putting lights in more places. They're putting security cameras. They're making sure it's fenced, making sure it's operationally working from a physical standpoint better. This is all the physical stuff we do, but it's all, the only thing a customer would see physical, obviously if we painted it, and there are occasions where you would paint it, maybe that makes slightest bit of difference. But from an operational standpoint, if we re-gravel it, or if we're putting gravel where the gravel's dried up or gone away, or, there used to be puddles or something, that's the only visible difference that most customers will know. And even those CapEx projects are further and fewer between than you think. I mean, there's always a little something we're doing everywhere at every facility, but at acquisition, but they're not major products. They're projects. I'm sorry. They're not major, like, move that bus and here, oh my God, it's a new storage facility. It's not that doesn't happen. So the where we add value is, you nailed it, in operations. It's in marketing. It's in operations. It's taking a traditional facility that we take over from a classic mom and pop. Classic story looks like this. If they have a website, it's from the MySpace era, right? And their rates are static, meaning they don't change. It's like, or they have a sign on the building, physical sign with their rates on it, painted on, right? Painted on rates don't change that often, right? So it's from a management standpoint, it's little stuff like that. When we take over a facility, you can find it on your cell phone. You can rent a unit on your cell phone. We're going to require you to put tenant insurance or protection in place just to rent the unit. And you can pay for it. In fact, we're going to require it. You're going to put a credit card or a debit card, right? Usually don't find any of those features in a mom and pop, classic mom and pop run facility. Sometimes you find one of them, maybe their website is great, but they don't have the rest of the components working, right? And that's the storage customer today. If they weren't, has been trained through COVID to, that's how they don't really want to interact with you, with a person, an employee anymore. Worst case, they'll deal with a call center, but they don't really want to deal with you or having to wait to talk to you. All right. And a lot of our customers today, not most, but a lot, and it's the growing number, are the millennials. So they definitely don't want to talk to you, and they only want to do things digitally. Right. Yep. So you have to have that in place. And if you don't, you're losing business. And that's just from a customer service standpoint. Then there's the customer acquisition, right? So you have to be marketing. You have to have your SEO up. You have to be doing things that are making you rise to the top of the storage near me search, because that's all they're doing.
Right.
Where you were used to matter. It still matters. Your location matters, but not as much, because all I'm doing is storage near me on my phone. And if I'm new to an area, I definitely don't know where you are, right? So, and a lot of storage is transient. So what matters is storage near me. And if your ranking is high enough, you could get that customer to come to you, and you weren't even the closest facility. And if had they known the area, they might have gone there. Now that's just the storage near me. They could obviously always use the map function and find it that way. I'm just giving an example of why storage near me and SEO matters. It's because your ranking does matter in terms of it has a direct impact on your occupancy and your revenue.
Well, that's going to do it for part 2 of our interview with Joe Downs. We had so much good material that we're going to have to bring back a bonus session. So hopefully you'll tune in next week and catch part 3, which is going to be the bonus. And don't miss our huge announcement about I Survive Real Estate this year. It's happening September 12th, 2025. Hope to see you all there.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.